presentation contains current opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone and welcome to the Compak Market Wrap YouTube update for December the 11th, 2023. I'm Mo Ansari, President of Compak Asset Management and host of the Market Wrap podcast. You can get all of this media updates that we do simply by going to compak.com/media. Once you go there, you can sign up for this YouTube update. Whenever I put an update up, you will be notified automatically. You can also get the Compak podcast that I do on a weekly basis, a much more detailed view of the markets by simply going here and downloading the podcast app, which is absolutely free. You can get, just type in Market Wrap with Mo, one word, Market Wrap with Mo, and it is free. Also, there's a link right there. You will also receive the weekly Market Minute, a one-pager with my views and observations. All of it is there, so make sure you go ahead and get all of the details. Looking at the markets, S&P closed at 4606 last Friday, finally getting above the 4600 number. Next resistance is 4607. Once we get above that, that's the intraday high that we made in July. Once we get above that, probably 4818. That's the only other resistance that I see, which is the all-time high. I don't know if we get there before the end of the year, but it's going to be important to see how the market reacts in the first 5 days of January. That's the way January goes, as the old saying goes, and the way January goes, that's the way the year goes. So that's going to be important. For the week, the market was up 0.24%. The S&P about 0.25%, not a lot. And if you look at the Russell, it was up. That's the large cap. It was up more. And the small caps up 1%. That was a nice move on the small caps. You're seeing the market broaden out, which is a great sign overall for the market. Looking at the best sectors, communication services, consumer discretionary, that is consumer spending. Expected to be, we are getting retail sales, which were okay. Then we're starting to see last week, we did get the unemployment data slightly hotter than expected. Expectation was for 190,000 jobs created. We got 199,000. Also, the unemployment rate fell from 3.9 to 3.7. But overall, I don't think that changes much for the FOMC meeting that is going to be held this week. And that is going to be the main driver for the markets this week and for the rest of the year. What does the Fed chairman say? Is he going to say that we're not going to cut rates anymore? So that's a good sign, because now he's not talking about raising interest rates. He's talking about bringing rates down. And as we talked about in the weekly podcast that showed you the data, what the market has done when there's high debt levels that the government has. And I'll talk about that also on the weekly podcast in more detail. Consumer discretionary technology was the third best sector for the week. Looking at the fixed income market or the bond market, the yield on the 30-year is here, 10-year is down to 4.25. I think we might get, tomorrow we get the CPI, the Consumer Price Index, that's inflation. Expected to be 0.3%, might come in a little bit hotter than expected. We'll have to wait and see how that looks, but it is just about the same. Interest rates haven't changed. They're 4.22 last week, the week before, now they're 4.23. Not a big change there. Oil, which was $80 a barrel last year, is below $70 a barrel. 69.33 is where it ended up for the week. And when you look at last year, it was $80 a barrel. So a big decline in oil prices, and it's just an oil production war going on. OPEC keeps cutting, we keep raising production, and that's going to be the key. OPEC can keep cutting, but as long as we are producing more and more oil, that will continue to rebalance the market a little bit. We look at core inflation. If you take out shelter, which has been one of the biggest factors. 17% of the CPI is autos and auto-related products. That's coming down dramatically. But you look at shelter, you can see that core, minus the shelter, that's this blue line right here, it is down to the 2% level. That's the Fed target. Close to that now. and we think shelter will continue to come down. That is rents. But rents, as I mentioned over the summer, that as I said, that rents, once they go up, don't come down very quickly. But we looked at the trend, and I saw the trend coming down into end of this year and early part of next year, and that will continue to put downward pressure on the inflation market. Job openings dropped to 8.7 million. That means the number of jobs available now is starting to come down. Initial claims for unemployment was up to 220. And the non-farm payroll, as I mentioned, 199 compared to the 190. This week we get the CPI, we get retail sales, and the big one is the Fed meeting. What does the Fed? They're not expected to raise rates. The question is, what are they going to say? Are they going to say that, look, we're done raising rates, now we'll talk about, but we're not thinking about cutting rates, which is obviously saying, look, we're done raising rates. So that is a positive that we want to hear from the Fed. When is the Fed going to decline? I looked at that in a lot more detail, and I'll show you the chart in the podcast in a lot more detail. Looking at the market, we're above the July high now at 46.07. Right now we're trading at 46.18. Next resistance, if you project the Fibonacci from here, from this high, we get 46.84 to 47.32 on the daily charts. That becomes the target. Now this is wave 5, so it will be a wave where we end up on the dailies. Now all of this was an ABC, as you know. I talked about that. Now we're starting to see a move to the upside. So are we going to get to this 46.84 to 47.32? There's a possibility we could get there if the Fed comes out with a dovish statement and if we see the CPI come in lower than expected, which I really don't think. I think it's more sideways to slightly higher for the rest of the year. Looking at the weekly charts, again, if we can decisively close above here, then 48.18 becomes the next target on the weeklies, which is the all-time high that we made at the beginning of last year. The projection from this, the Fibonacci projection, comes in at 5,000 to 5150, but that might be a year and a half away, because each one of these vertical lines, the red and green lines, are 1 week of trading going back all the way to about 2019. Looking at the NASDAQ on a daily, this is the all-time high. This is the high that we made this year, 14,440, 450 or 446. This morning we're trading at 14,421. If we can get above 14,450, that would be a very nice move. Then the projection comes in from the Fibonacci projection from this high all the way up to 15.4 to 15.6. So we will see. That's another 1,000 points higher. I don't think we get there by the end of this year, but you never know, depending on what the Fed says. On the weekly charts, again, the dot plot has turned positive, where the dots are below the market. Usually when they turn up or down, the market gets below the dots. It's a bearish sign. When the market is above these dots, it's a bullish sign. Again, resistance here, and then the projection from this high on the weeklies coming out to about 15,000, a little bit lower than the dailies. So we'll have to wait and see how this plays out. Then the all-time high that we made at the end of 2021, and that's 16,212. But I think 14,800 to 15,000 is much more of a realistic. Interest rates continue to come down. As I mentioned last week, I think we might get a bounce up. We got close to the 4%, 4.1 is where we got the 200 days, 4.03. Could get a bounce up to 4.34, which is the 20-day average on the yield on the 10-year. If we get above that, then we're looking at 4.5. I think we get up to 4.3 a little bit. We're up 2.3 today, so a little bit of a bounce in rates would not surprise me. Oil continues to come down, made a low right here. Now it's bouncing up a little bit, trading above the 70 mark today at 71.34, up slightly. Resistance is going to be right around the 74.79, the 20-day moving average, and then the 200-day, which is 77.93. Gold, which made that all-time high, has come down sharply. Big correction here. I think this looks more like a fourth wave. Could get as low as 1470, which is the 50-day moving average, or 1970, where 1996 today is where we are trading. A little bit more back and forth here. before we start moving back up to the upside in the gold market. Those are my views. Those are my thoughts for December 11th. Don't forget to tune in to the much more detailed, nearly 45 minutes to an hour update that I do on the podcast. If you sign up for it, you'll get it absolutely free. Have a wonderful week. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.